Good afternoon, everybody, and welcome to the webinar today. Thanks, everyone, for joining. I'm your host for today's webinar, and our topic is Even Passive Investors Need to Know About Financing. Many of you already know me, but some of you who do not know me, my name is Loomba, and I'm a founder and CEO of Loomba Investment Group. I have a very strong IT and academia background. I've also done some commercial brokerage in my previous life. I have multiple years of corporate America and academia experience as a professor at California State University. At current, I'm a commercial real estate investor and a syndicator. I host and facilitate educational webinars every other week on Fridays and try to bring some interesting topics on real estate, multifamily investing, and syndications. Today, our guest speaker is Julie Ann Peterson. She's going to educate us on financing, or even passive investors need to understand financing. Some of the housekeeping items: please use Q&A box for any questions instead of chat box. We try to address all the questions after the presentation. If we didn't get to your question for some odd reason, please send an email to winky@loombainvest.com and we'll provide you with the answers. This webinar will be recorded and recordings will be sent out to all. Recordings will come from winky@loombainvest.com. To avoid emails to end up in your spam or promotions folder, please whitelist my email. So what do I mean by whitelist my email? Please add me to your contact list. So before we get started, small little disclaimer here. This webinar is strictly for educational purposes and should not be considered as a legal, accounting, or investment advice. This webinar does not represent an offer to sell or a solicitation for an offer to purchase an investment or security. The strategies mentioned in the presentation may not be applicable for everyone. The information presented is believed to be accurate and reliable. We make no representations or warranties, expressed or implied, as to the accuracy of such information, and we explicitly disclaim any and all liability that may be based on such information and/or errors or omissions thereof. Please consult with your own attorney, financial advisor, and CPA for all legal matters, investments, and your specific tax situations. Once again, this webinar is strictly for knowledge sharing and for educational purposes only. About our guest speaker, let's welcome our special guest today, Julie Ann Peterson. Julie is a senior director with Old Capital. Old Capital is a premier provider of commercial capital solutions and advisory services for commercial real estate investors of multifamily, retail, offices, and industrial. With 30 years of real estate transaction experience, Julie Peterson does not just source funds, she consults with our clients to help solve immediate needs as well. She works with all types of income-producing real estate and at all levels of capital stack. Julie's clients are real estate entrepreneurs who are dependent upon the many relationships they establish, and the relationship with the capital provider is no different. Outside of work, Julie enjoys spending time with her husband, 4 children, and Walter, the dog. How to reach me? You can go to my website, loombainvest.com, and you can download a free ebook, 7 Reasons Why Real Estate Syndication Build Long-Term Wealth. Or you can connect with me on Facebook, LinkedIn, or you can follow me on Instagram. And let's start with our session today. And I'm looking forward to this informative session with Julie. So let's welcome Julie. Julie, you're on.
Thank you so much for having me. I do appreciate you all joining me on a Friday afternoon. Maybe you're starting your cocktails a little early. Again, my name is Julie Ann Peterson, and I am with Old Capital Lending. We have been around for many, many years, 36 years. Hopefully you can see that now. You see my screen. I am located in the great state of California, along with Vinky. I am in San Diego, so it's a beautiful, beautiful day here. And but you know what? We do no loans, really, for the most part, in California or on the West Coast because it is too darn expensive. So Old Capital's been around for 36 years. We do $1 billion a year in loans, and we have 11 people. So that's a lot of loans for a little small and mighty company. We've closed 3,800 loans. We do the majority of our business, and we'll talk further about this, in agency debt. So that is your Fannie and Freddie. We do bank loans. We help where you may be too busy. We'll help you with those bank loans, or on the credit union loans. We'll do that with you. We also do bridge loans, and we do CMBS, which is your commercial mortgage-backed securities. These are a couple pictures of some of the transactions that we have done in the past. Again, I've been with Old Capital for about 3 years, but I've been in business in real estate for 30 years. 21 of those, I've been a property manager, owner, landlord, and I am done. Coming up April 30th, I am going to be selling the last property that I own. So what I do want you to know is that I've been in your shoes. Many of us came from single family and transferred into multifamily. I did that probably about 10 years ago. I'm a limited partner as well, looking for GP status on other transaction. And what I want you to know is that you're not alone. And I felt a real alone when I was going into commercial lending, buying commercial buildings, because you're just a little bit, you can feel a little bit overwhelmed. A lot of these mortgage brokers will say, you know, move along. And I came to this business saying, I am not going to let anybody slip away with that attitude that I'm not going to help you. So I do a lot of business with new investors. I also run a Zoom call. Some of you are regulars on my Zoom call. It's Zoom at 8, which is 8 p.m. Eastern. We have some fabulous speakers, and my goal there, we've been doing it for 2 years, is to really build a network of investors and other partners, so that if you have a transaction and you don't have a team set up, that you can build your network with us. These are just some of the cast of characters. Let's see, is Trevor's in here. Look at that, Trevor, looking good. But we are at Old Capital about investing in our investors. So we really want to educate you. And one of the things that we started 5 or 6 years ago, one of the first was our Old Capital podcast. And a lot of us know, a lot of new investors come to us just because of hearing us on the podcast. We're on, you know, Apple, we're on YouTube, and we're on Spotify, and you can hear us every week, sometimes a couple times a week. We are sending out great interviews with real-time investors like yourself, and people are sharing some of the challenges. We're also meeting up with vendors, and we're talking to property managers, and we're talking to some of our underwriters. So it's a great place to learn and get started. We also run our Old Capital Conference, which is a yearly conference where we've got about 800 people come, and this is the place to be. It's a 1.5 day conference, and we've got great speakers and a lot of people learning a lot and making some really good connections. So Old Capital spends a lot of our time in multifamily. So multifamily, here in this example, you can see we're doing your bank loans, we're doing your recourse, non-recourse agency, we're doing bridge, CMBS, and private lending, although we don't get into the private and we don't get into hard money. But as you go across, these are all the different types of assets that we will provide. We also will do student and senior housing in addition to these. So if this is something that you're working on, I'd love the opportunity to look at it. All we need is your T12 and rent roll. So let's talk about the market. This comes with no words. We all got shut down a year and a couple months ago, and we never thought we would be in a situation like we are today. Me being in California, we're still wearing our masks. And it's funny to talk to some of our investors that they're like in Indiana and they haven't worn masks. So depending on where you're at, this is really influencing the way that you live. And we have gone through so many changes, whether it's been in your work, where you're working, how you're working, kids at home, kids at school, a lot of changes especially in real estate. And with that, a lot of people saving money. There's tons of money on the sidelines. And a lot of it is coming in from other places like China, Japan, we've got Germany, we've got Trinidad. A lot of these people are getting negative returns. So they're coming over here. And a lot of times when you show up, and we have these conversations like, how did that person show up and pay $1 million over? We just don't know where this money is coming from. So it always boggles our mind when you see that you're getting so close and so tight on your returns to your investors that potentially these other groups have 1031 exchange money, or they're simply trying to utilize their cash as a tax deferment or tax shelter on some of these other countries where they're getting high taxes. So let's talk a little bit about the market. 3 big points that really do need to have a conversation. It's jobs, rent growth, and collections. Those are the things that I would say, if there's something to talk about struggle, those 3 things are top of mind. So I really like these total employment. If you look at the graphs on the right side, I love this because it shows the velocity of the change that we went through with employment and unemployment over the last year. You can see that we're talking about 19 million people out of jobs, in a very short amount of time, and how we've got growth, we've lost, and we're still adding jobs, but we're simply short 9 million. And it depends on who you talk to. Some people say they're at 6 million are out of work, and some people are saying 13. So it just depends on how you look at those. I can tell you that there are 4, not for rent, but help wanted signs all over our town. My husband is trying to get people to come join his company. It's amazing how many people are sitting at home collecting stimulus pack money and not going out and taking these jobs. So there's a lot of growth in jobs. We just aren't placing people there yet. The other thing is rent growth. We talk to a lot of operators, and yeah, there are some that say, yeah, no problem, we haven't had hardly any problems, but there is some deterioration in some of the smile states, less than maybe even negative rent growth. So keep that in mind, the affordability of some of these transactions. Some of the development deals, a lot of the supplies have gone up incredibly. So it's cutting into margins. So we're hearing that rent growth is, but there are stories of evictions and the struggles with those, and that once you get these employees into these programs while they're there for you, it's hard to get them out. So glad that the country is taking care of some of these, but some of them need a little boot to get them off the couch. We see a lot of capital, like I say, on the sidelines, a lot of it coming in here. We've got strong debt. We're seeing a lot more influx of bridge lending, which wasn't there when COVID started. The stimulus package, as I mentioned, I got my $5,600 check. My son said he just got another $600 check. So a lot of money is out there for people to be using. The GDP growth right now is at 7%. So for 2020, we are in good standings. This is our buddy. He is our Fed chairman, Jerome Powell, and I will tell you that we like what he says. He is telling the American people that we're going to keep the interest rates low. And we know that at 2% is the beginning of inflation, and we're right at the cusp of that right now. We just dropped pricing 10 bips this week on the 10-year Treasury. Now, we'll go into a little bit more details on that, but we really are looking for a pretty steady interest rates over the next 3 years, and we are counting on this guy to hold tight on those claims. Again, these are the loan types that we carry. Bank loans, you get 5 years right now. You're getting 20 to 25 year AM. These are 75% loan to value. There's some great bank financing. Agency may not be the best for you. There are some stumbling blocks. And if bank is something that we can help you with, let us know. Freddie SBL has been another great product that we work with. But the other three that we've seen an incredible shift over the last, let's say 3 to 4 months, we're going to spend some time talking about it. Just a little bit of a recap. When we look at agency debt, and we do about 93% of our business is in agency debt. And this is just a little graph that quarter over quarter, quarter 4 on 2019 versus quarter 4 2020, we're seeing 73% of the loans out there are with agencies. So a lot of people are still investing using this vehicle. It is the gold standard. It keeps you buying assets Monday through Friday. It doesn't stop you. We see a lot of growth continuing. Here's a Walter and Dunlop. They're speculating that we're going to continue to see growth in multifamily. We've seen a little bit of a drop, but consistently increasing over the next 5 years, 4 years in this case. The 10-year Treasury is what drives the pricing on these agency loans. And as you can see here, 2020, March 2020, it just dropped like an egg. And we really slowed down for at least 6 months. We were not doing any loans. We probably all could have gone on vacation. But slowly and surely it's starting to rise, and that is affecting these loans. At the beginning of the year, it started out at 0.02. That's in January, 0.02. I'm sorry, that not on Fannie, but on Freddie, and we'll see that next. But you can see the interest rates. This is on Fannie in January. We're looking at 3.25, and now you're looking at 2 months later, and even now we're really right about the same at 3.85 on a 7, 3.75 on a 10-year. So that has been impacting how people are looking at these transactions and seeing, does it still make sense? Because don't forget, you have to capital raise your COVID reserves, which are 12 months interest and principal and interest for a whole year. You got to put that in an escrow account, and we'll go over that a little bit more. But you also have to capital raise your CapEx for your rehab. So those are 2 areas where if you're new in this, that is significantly impacting maybe your ability to get the deal done, and it is risky when you add those extra income to the transaction. So looking at Freddie is we call it the Freddie floater, And the Freddie floater is based on SOFR. So this is, it's an index. We do 10-year Treasury index for the Freddie and Fannie. And then on the SOFR on the Freddie floaters. So this is, we're seeing really low rates. We were at 0.09 in January, and then it dropped to 0.02. So that gave us a lot of confidence in a short amount of time that, wow, this is a great opportunity to get into these floaters. Well, Freddie said after a little while, they started looking that the SOFR rate and the LIBOR rate in particular were starting to climb. We see this forward curve, and we really thought that we were going to get to 1% in LIBOR and SOFR in about an 8-year period. You can see 1 year, we were speculating it to be hitting in October of 2028. Well, this pressure in the seeing a lot of these rates moving, we're seeing now it actually getting to the same point of 1% LIBOR actually showing up in 2023, 2024. So we're really condensing, we're moving up that to the 1%, and what that is causing is a lot of uncertainty. And when you do these types of loans, you have to take out an insurance policy because this is an adjustable rate. So with the uncertainty, if that SOFR or LIBOR is going to increase, these rates for the rate caps are increasing. Back in May and March and back in January, rates were incredibly low for these rate caps. This is a great show of what we're talking about. So back in April 2020, you can see we were at 40,000. So let's talk a little bit about this. When you use these types of loans, they're adjustable rate loans, they fluctuate, right? So when I quote you a 4% loan, it could go up, it could go down, but let's just say it does go up. When you buy a rate cap, this is an insurance policy that says, hey, and in this case, this is a 1% strike. That's saying if I sell it to you at 4 and it goes to 5, I, as the consumer, I, as the borrower, have to pay for that increase, and my debt service payment would increase. When it goes above, and in this case, 1 strike, 1%, it goes to 2%, this rate cap company will pay for the difference. So if it goes up to 2%, I paid for 1, you would reimburse me, the lender, I'm sorry, the owner of that property who owns the debt service on it, 1%, okay? So it's all speculation of what's gonna happen in the market. And as you can see, it started to go down, decrease. In January, we're starting to see it come up a little bit. And looking ahead, we see it rising. So when you're looking at these rate caps, we can look 2 years, we can look 3, but when we look at 5 years, it gets super expensive. And you can see here, depending on how long, here's a 5-year term, you can see how expensive these costs. And you can't get away from these. These are typically on a bridge loan, you have to buy this rate cap. Now, depending on where the asset is and how much it is, sometimes they don't require this, but for the most part, 75 to 80% of the time, you do have to buy this rate cap. So you can't forget about it because you have to put it into your underwriting before you purchase. Okay, it can be a significant event. Keeping in mind, if we're going with a 2 or a 3 year rate cap, if you decide to extend one of these loans, like on a bridge, you're going to take out a 3-year loan and you're going to hold it to the extension of a 5-year loan, you have to go back and buy a rate cap. And that it could be up to $250,000. We just don't know. So that is the risk in taking on the bridge lending. So yes.
Can I interrupt you for a second?
Sure.
If you can go back to your couple slides back, and you were talking about LIBOR.
Yes.
Would you please shed some light on LIBOR for our viewers?
So LIBOR is it's London. It's we've used it over many years. This type of index. This is what we use for our adjustable rate product. It is based on this type of index, and as you can see, we are actually, so LIBOR is going to go away. And so once, like over the next, we've been talking about it for several years that LIBOR was going to go away and SOFR was going to take over. We're still seeing LIBOR, but I would say over the next year, that's going to go away and SOFR will pick up. They're both very slow, typically very slow moving indexes. But as I mentioned, this movement, we weren't thinking of seeing it for 8 years. And this was kind of the trajectory or the forward curve that we were going to be seeing. It's slow. And so it gave us a lot of certainty that if you go into one of these types of loans, that there'd be very small amount of movement. But that's kind of changed over the last, let's say, 3 or 4 months. We're still believing that, if you get into it right now and you have a 3-year cap on it, and that's going to be your business plan, I think you're in a good place. It is starting to rise because of some of the uncertainty. It's just like, why do you pay more for a car, rent to get insurance on your car, let's say in the middle of Chicago, or is it going to be more expensive out in the suburbs? Typically, where things may be a little bit more people, more possibility of it getting hit or getting carjacked or whatever, stolen, those rates are going to be higher. So as we see that maybe this SOFR or LIBOR index is going to be ramping up a little faster than what we thought, those rate caps will become more expensive. And when that happens, you're going to see the shift go back into agency. And hopefully when that happens, hopefully the COVID reserves will be removed, that we won't have those anymore.
Okay, so I have a follow-up question on that. Mm-hmm. So would you say LIBOR is just like kind of a benchmarking? And then what kind of relations it has with the US Treasury?
It's completely separate. Completely separate. Yeah. And I would tell you that in the past, they haven't, I used to have a loan on my home that was on LIBOR, and this was back in 2008, 2005, and everything was going crazy. And so for my LIBOR, it was, less than 1%. It was really, and it's still along that same trajectory. It's been slow. So anyway, that they're two separate indexes, and they don't necessarily, if one goes up, the other one goes up. It's not, they haven't gone hand in hand.
Okay, thank you.
Sure. And there's the rate, and we talked about the rate caps. When you do a Freddie floater, Freddie floaters are an amazing product. Right now, they're doing a lot of it at 65 and 70% loans. But what I love about the Freddie floater is it's 1% to get out of it after the first year. 1% prepayment penalty. We talk about step down, we talk about yield maintenance, and a lot of transactions right now, people got into them like 3 years ago, 2 years ago, and we put yield maintenance penalties on them. The prepayment penalty is called yield maintenance. And basically people now are trying to get out of those, and the yield maintenance penalties are $1 million. So and I think you're going to see a lot more of those. The shift now is to go into step down, because if you end up wanting to change your business plan, a lot of these people thought, well, I'm going to hold on to it for 10 years. Well, nobody's really holding on to things 10 years. There is a small community that gets into legacy assets, but for the most part, what we're seeing in the syndication model is that you're in it for 3 to 5 years, really 7 on the high end on the longer term. But and so these yield maintenance penalties are really handicapping the investors because they can't get out of them. They don't want to pay, and they're being hit with evictions. So the collections are challenged, and now you're trying to sell it and you have to give up more. This is not going to your investors. This is simply going to the bond market where it got secured, and they're the ones that are making the money, not Fannie and Freddie. So nobody really makes out on those yield maintenance penalties. So if you can assume a loan and not have to pay that yield maintenance penalty, that would be great. Although, I mean, to me, it seems a bit challenging in some of these transactions where they're not. A lot of these sellers don't want to give up. They want to get the same. They don't want to give a discount for somebody helping them out to get out of these yield maintenance penalties. So,
but how are the yield maintenance penalties decided? Like the percentage wise, what's the deciding factor? Like how much the yield maintenance gonna be?
Oh, well, it really is based on what was the agreement when it was taken out, when it was sold to the borrower. So if it was, they were told, if the lender told their investors on the bond market that they were going to be getting 5% on their loan for the next 10 years, they're happy about that. And so what it is actually a function of the interest rate. So if the interest rates go up, those investors will have no problem getting out of their 5% if their interest rates go up to, let's say, 7%, 8%, because they want to get out of those low paying interest rates and go to the higher. So there's less penalty to get out of it. But let's say you took it out at 5 and now it's 2, 3%, which is what we're seeing affecting a lot of these borrowers. Now you have to make up for what you paid for it and what the rate is today. There's a big loss there for those investors that were told for 10 years they would receive it at 5. So I know that's kind of a simplistic way to look at it, but it really is driven by the interest rates and how much is left on the loan. If you have 3 years left, it's going to be less than if you just took this out and you've got, an extra 7 years, because those people need to be made whole. So I think in an environment, it's certainly something that we should be thinking about. Like, what is the buying environment right now? Who are interest rates going up when you're buying right now? I think you would, we've talked about the feds are going to hold interest rates low, but if you heard me say, we're seeing them kind of going up, a slow increase. We went up 50 bips, we came down 10. Now, is it going to continue to go down, or are we going to maybe come down 10, go up 15, come down 5. I actually think it's going to continue to slowly rise. And in that environment, your cheapest loan is a 10-year yield maintenance. So if you're buying it now at 3 and you're exiting in 5, a lot's going to happen in this environment over the next 5 years. We've got obviously a new president. We've got a stimulus package that's pushing against this inflationary concerns, and we've got maybe the vaccine. We've got people unemployed. So there's a lot of indicators that would say interest rates are going to go up. And so does it make sense? Because when you go into another type of prepayment penalty called a step down, you're going to pay anywhere from 30 bips to 50 or 60 bips for that. Again, that's kind of an insurance policy to get this step down. And the way that the step down works is every year it steps down less and less of a penalty. So the first year would be 5%, second year would be 5%, third year would be 4%, and then 4%, 3%, 3%, 2%, 2%, 1%, 1% over a 10-year period. So if you like to sleep at night and you like to, dot your I's and cross your T's and know exactly how much it's going to cost me to get out of here, and then you can model it, then step down prepayment is the way you should go. If you're of the belief that I'm going to hold this for 3 to 5 years and I'm out, then I think it's worth the conversation and thought and support of a yield maintenance penalty. Remember, these types of loans are assumable. So let's say you're in it for 3 to 5 years, you go to find a buyer and interest rates are at 8 and you took one out at 4, you've got something to be thinking about, and there is a lot of value to someone buying that asset from you. It's just an added benefit. So I think that this is what we do as mortgage lenders, as mortgage broker. I consult with you to find out exactly what your strategy is. You really do need to have a business plan. It's not just, oh, I'm going to go buy a property. It is, this is what I want to achieve. I want to, have a 17 IRR. I want to hold it for 3 years. I'm going to have 3 years of interest only, and then we're going to do some CapEx, and then we're jumping out of it. That is a business plan. Once you have it and you've modeled that and you're ready to put in an LOI, that's when we meet and we go through all of these different scenarios and we find the best product for to help you execute that business plan. So going back to bridge loans, this is the other option. So we have Freddie floater, we have simply Fannie agency, and then you have bridge. That's these are the 3 that we're really working with right now. So bridge, this is just an indication of what has happened over the last couple of years. 2018, people were doing a lot of bridge because we were on the cusp of thinking it was going to go down. So people wanted to get in and get out, do your CapEx and sell. It can be considered a risky platform to be using bridge if you're not aware of how to do your CapEx, how to execute these returns to your investors, as well as how do you return, getting these, re-renting, releasing these assets after you do a pretty comprehensive rehab. So that needs to have a good sponsor so that they can hold your hand and help you so you can be successful. In April, right when we hit COVID, everybody disappeared. Not only did we see a freeze on agency, but a lot of bridge lenders took off. They were not in the market. And that lasted for quite some time. Actually, it was not until August, and it was late August, even September, that we saw the new entry. And the debt funds, which is another word for a bridge lender, the ones that were in 2018 are probably not the same people that are in the market today. These are people with high amount of money, large capital partners that go out and give out loans. They sell it on, they securitize it in the bond market, and then they go out again, get some more money, and do the same thing. So right now, this is where we're seeing a lot of the lending going into bridge loans. What we do like about it is, as I mentioned earlier, you don't have the COVID reserves and you can roll in the rehab, which is simply amazing. When there is a lot of NOIs that are not constrained by debt service on a Fannie product in the past and will be in the future, we've seen where you can roll in the rehab. But with all of the concessions and the bad debt and the evictions, we haven't seen a lot of rolling in the rehab on a Fannie product. So this is your option. And what I love about this is 3 years of interest only. Get in, get out, and if there's a problem, I'm going to give you an option of 1 year and possibly another year to get it done. And that's at 100%. Now, sometimes it'll be 75% of the CapEx, but most of the time it's 100%. So it's 75% LTV plus 100% rehab. Those numbers end up anywhere from 77% up to 89%, depending on how big that loan is. I mean, that's loan to cost. 89% loan to cost is huge. So it's opening up a lot of doors for people that had to walk away when when they started looking at agency. It just wasn't making sense. So let's do a comparative on a $30 million deal. So the first one is going to be on the Fannie product. We're going to give you at not at 80%, we're actually going to get it down to 70%. It is an 80% market, but maybe it's not performing. So not performing at 70%, we're going to give you 3.5 to 3.75 in your interest rate. I am going to ask for those reserves, and we're still in a 1.25 market on your debt service. Okay, so debt service at a 1.25 is a top market. So this indicates it's maybe someplace like Dallas, maybe Austin, maybe Boston, Chicago. That is this type of loan. Okay, it's a fixed rate, so you don't have to have that rate cap. All right. The next one is Freddie. It's no longer going to be at 80%, but rather at 65. And when we're looking at these types of loans on a syndication model, is asking for the most loan dollars at the lowest price. So the most loan dollars, so you don't have to capital raise. So our second option is Freddie floater. I'm only going to 65%. So now I'm at 19.5 million. So I got to bring in a 1.5 million more dollars. The rate is fantastic. It's 3 to 3.25, but I also have that extra rate cap that I have to buy. It could be 100,000. I also have to bring in the extra principal and interest reserves on this product. You do have to make sure that you remember that you're going to have 1% to get out, which is pretty spectacular on this deal, but you're not getting as much loan dollars. Great product, but it does have limitations. Then the last one, so you can see it comparatively. And when you give me a call and you say, hey, I've got this opportunity, this is what I'm doing. I'm out there buying, trying to buy you the right product for that property. This is what it's looking like. So it's $24 million now on that $30 million transaction. I can give you much more loan dollars. So now you only have to capital raise 6 million as opposed to 9 million. I mean, it's amazing. You don't have the COVID reserves. You will have that rate cap. And by the way, on those rate caps, we also may have to have you have a, it's called a DACA. It's kind of a lockbox. So because there's a lot of moving parts in bridge financing, some of these banks will ask you to put this deposit account on the transaction. And so if you drop below the debt yield that they determine is what they're going to allow on this transaction, if it drops, you go into this thing, it activates this lockbox. And you can go in and out of the lockbox 2 to 3 times during that 3-year to 5-year period. It's not uncommon. It is truly a function of, doing the repairs, people moving in, moving out. So you have to be really careful. Again, why we want to see somebody experienced on these type of transactions so that you minimize going in and out of the lockbox, because basically all of the deposits go there and the bank now is managing the account. So you got to just be aware of that. There is a cost associated. I will tell you this, on a Fannie loan, your application fee is anywhere from 10 to 12,000. When you get into a bridge loan, it's $60,000 to $75,000. That is a deposit, and the money will go towards your closing costs, but it is expensive. So be thinking about that. That's money up front that you need to be putting into this transaction. So new folks, I just absolutely love that you're here, but I want to make sure that you're aware of some of the restrictions or some of the challenges when you're getting into these. You want to be buying assets that you can perform well on. Not looking at 1,100, 1,200, 15, 2,000 units when you don't have any experience is it's challenging for you to get it done. You want to have the best ability to close. And if you have no experience, a lot of lenders will say, I can't get this for you, and they'll get kind of mean and they'll say, let's not waste our time. So look at transactions that you can take down with the right partnerships that you have made and that are in, part of your team. Over the last year, we put in place these COVID reserves. This is kind of a quick overview of where we were. I've crossed out what has been eliminated. But for the most part, we're talking 12 on Fannie, we're talking 12 to 18 months of principal and interest reserves. We've gotten rid of the insurance. We've gotten rid of the taxes that were required to be brought up front. That's gone away, but simply principal and interest. What happened back in February is that we saw a shift into this idea of, if there are stable rents and if there are limited payables, okay, or receivables rather, then I can waiver into this idea that instead of it being 12 months, I can actually minimize that to, and that was principal and interest, I can waiver into 6 months interest only. And that's on your COVID reserves. So that's just kind of the shift and change that's happened over since February. Quite frankly, I haven't seen too many of them get waived, but this is the opportunity to maybe take a closer look at the opportunity to have those waivers. This is not available for senior and student housing, and it really is from assets that are loan amounts that are 3 million and above. So when you're below 3 million, you go back to 18 months principal and interest. It is expensive. We don't do a lot of Fannie small balance. We do a lot more of Freddie small balance. They also they put in these COVID reserves. This is an example of what it is currently. It's 12 months. The only change that they did was we changed the debt service. So instead of it being 1.45, it's now on an acquisition at 1.35. So you have less money. It's actually going to allow you to get more loan dollars. So that's cool. When you're getting into these different types of loans, you want to think about what is the risk tolerance of my investors. When you're going with a bank loan, that's going to be less risky than, let's say, your agency. Agency is going to be even less than going with a bridge loan, because again, we don't know what's going to happen in 5 years when you need to get out of that. You know, if we're thinking that our reversion cap rate is going to be, 10 above or 50 above, are we going to be able to execute that if interest rates are really high? You may have to drop, or rather your cap rates would increase even further, which means you would be giving less out to your investors. So all things to be thinking about, really understanding what's happening and how you should be modeling these transactions in your underwriting tool. Are there any questions so far before we go into simply what do I need to do? What is required to get into a commercial loan? Any questions?
Can you talk about a little bit about the lockbox? Is there a time limit for the lockbox? So what exactly is it? And from the passive investor perspective, what would it look like?
Yeah. So, it's actually, it's a function of performance. So once you would raise those debt yield, when there's less of a spread on the debt yield, okay, let's say we give this to you for a debt yield of 8.5, and it drops down to 6.25, let's say. That's going to activate the debt yield, the DACA, the lockbox. And then once you are able to get that up higher, then we will take the lockbox off, and then you're back to managing your business. Let's say you're in the lease up phase, it's not going as fast, you don't have income coming in, we keep sending out more capital. It's not a default, it's simply a function of how much money is coming in and what's going out based on the metrics of the transaction. Maybe it drops, we would put the lockbox situation on again, we'd watch it. Do we want you to go into a lockbox? No, that's not our goal. Our goal is to keep you out of the lockbox. It's there to help you so that you don't lose the transaction. Maybe it's like purgatory, if you will. It's just having you sit there before it gets to a failure rate. So it really is, again, it's kind of like an insurance policy that will help you get stabilized and moved back up to where we assessed it as a working and viable transaction. Anything else on that?
Please put your questions in the Q&A. If you have any questions, please.
All right, what I'm going to do is I'm going to go through real quickly what it takes to get an agency loan. I get this question all day long, and I think it's imperative that our new people understand. We talk about a 4-step process when we're getting into multifamily. The first one is your business plan. What kind of assets are you going to go look, you're going to consider? How many units? What is your return going to look like? What are your metrics? And you're going to be surveying your investors at that time. And what do your investors want? And what kind of returns do they want? And you look at the market simultaneously. What market am I going to be able to get the returns for my investors? And what will my investors want to invest? Because I'm not going to be investing in North Carolina if none of my investors want to go there. Or maybe my investors need 10% returns, and where I'm looking, I can only get 6% returns. So there is a balance, and there's also an education piece. So when you're talking to your limited partners, you got to make sure you say, okay, I know you want 10, but there are no markets right now that we're seeing that are effectively returning that capital on day one. Maybe after you get it stabilized and you do your rehab, maybe. But for today, I'm seeing 7-8% prefs. So you do need to make sure that you're understanding what is happening in these markets and educating them. I think it's very important. So there's 4 things that make for the ability to get an agency debt. Again, this is the gold standard. When you want to accelerate, when an investor comes to you and wants to have very good returns, stable assets, a lot of times they're hoping or you want them to know about this agency debt, Fannie and Freddie. Fannie and Freddie put these out there to help Americans. It has to be, the transaction needs to be 90% occupied for 90 days. So if you are the investor, you have to understand that when you're looking at these transactions, that GP or that management team is considering assets that are 90%, because that's where we get the best return, we get the best financing in 90 and 90. These 3 other ones are where you bring your teammates. One is net worth. You need to have the net worth greater than the loan amount. So if you're looking at a $10 million deal, and I say that if you're brand new, that I think that's a little bit high, but just for this example, $10 million deal at 75 is $7,500,000. I'm going to need net worth greater than that. So let's say it's 9.5 and $1. That's how much net worth I need, $7,500,000 and $1. Now that can come from one person, it can come from 4 or 5. Your best bet, and banks like to max out at 5 people on the management team, okay? You can have 10 people, but you're gonna probably put them under one LLC, so they get one vote. But you really only wanna have 5 people, and the more people you have on your team, the less money you get. So be aware of your teammates. We've talked about this 4-step funnel. This is where you're in the 3rd part of that 4 steps is finding your teammates. These are the teammates that have the network, that have the liquidity, who have the experience. And if you can find one person that checks all of those boxes, you're in great shape. But on a $10 million deal, maybe you find 2 people that can check those boxes, and that's fine. You do need to have money in this business. This idea of use other people's money, it works in cases where you can bolt some of these people on that will sign as guarantor, that will allow you to get into the transaction. They're bringing money for you. You're going to give up some of your cash because they're coming in with their own cash. Just think, if you brought in your own cash, you wouldn't have to split it with those people. The other parts now are liquidity. So we talked about 90 and 90. We talked about net worth. This 3rd one is liquidity. So what is that? That's not the down payment. We call it a post-close liquidity. And what that means is it is money that's sitting in a bank account. It is marketable securities, maybe insurance policy, your stocks and bonds. All of those have a cash value. Maybe it's the money that's stuck in between your walls of your house, where you've got a ton of equity and you have a very low bank loan on that. There's some money sitting there. You could put that into a HELOC, activate it, put it into your checking account, let it sit there for 2 or 3 months, and you're that amount. So you're looking for 10% liquidity. And in that example, the $10 million deal with $7.5 million in loan amount, you're going to need $750,000. Now, if you're like me and you get money, you want to spend it. You want to buy this asset. You want to buy that asset. So there's a lot of people that think that in this business, money is like crack and you want to spend it and you want to find the next transaction. But there are people out there that are standing on the sidelines with cash that want to get into these deals. So if you need 10% liquidity, you need to find those people and put them into the transaction. There are people wanting to take part in your transaction, and that's a great place for them. The last piece of this, getting commercial lending, is 2 to 3 years of experience, really 2 years of experience, and 3 to 5 transactions. So that can come from one person, it can come from 5 people. We want to see that you've been in transactions for some time. Certainly love to see that you've gone full cycle on some, but it's not like it's been 20 years ago. That's not what we're looking for. We're looking at what you're doing today. So you need to find those people. We've got a great network of people that come to Zoom at 8 who are there to help, that are wanting to be in transactions. So this is the information that is critical to getting into these commercial loans. Don't forget, if you're trying to become an investor or you are an investor and you're just not in a deal, start working today on your personal financial statement, because you never know when somebody's going to say, I got a deal for you. So start on it now, update it quarterly, and then make sure you're taking also a schedule of real estate where it is, if you're a limited partner and you put $100,000 in a $35 million deal, your money is worth, and your value or your net worth is not 35 million. It's actually 100,000 of the money that you put into it, at least that first year. After it seasons a little bit, maybe in 18 months, that 100,000 may be now worth 130,000. And yes, that asset was 35 million and now it's 37 million, whatever it is, but you have a certain value to your stocks. And when we increase the value of that asset, you get to take that along with you on your schedule of real estate owned. So make sure you're following that on your limited partnerships. And limited partners are really necessary. So don't think that, oh, I'm a limited partner now and I have to go be a GP, because limited partners, we need you. And we're hoping that you continue to do, stay with us for the next transaction and the next one. You are really the blood for these transactions. And who's to say that, it's pretty nice to be able to sit back and collect those checks instead of having daily conversations about things or having management issues. Let the other people deal with that. Be a great limited partner. We need you. And then the last piece is a resume. We're going to need to see your resume in regards to real estate. I've spent 2,000 hours in education. I have limited partnerships with A, B, and C. I have purchased these amount of single families, these duplexes, and I've done these types of rehab. So all of that put together, put a bow on it, call it a resume. We're going to need to see these. When you call me and you're looking at an LOI and we're going to say, who's on your team? We're going to want to see those from your teammates. Okay, so be having those conversations. And even as a passive investor, you want to know who's putting money into the deal. You want to know that the people on the management team are putting their own money in. Who's sitting in the cockpit of that plane. You got LPs sitting in the back of the plane, and we love you, but who has the experience up front? Who is putting in the money? Who has skin in the game? And get to know those people very, very well. Now, if you're with a new syndicator, you're going to look to who's their sponsor is and get to understand what are their successes. Because yes, while the person that you're investing in is new at this, he's hooking his horse to a really good sponsor, most likely. And so you just want to ask the questions. You know, what are your returns? How much have you given out back to the investors? And you want to understand their strengths. Okay. So when should you buy? The time is now. It's not yesterday, and it may be tomorrow, but the time is now. Understand, educate yourself, look for opportunities, do that 4-step process. Find your business plan, find your marketing plan or market plan, your teammates, and then find the assets. And by that, the asset could be an acquisition. You could be simply refinancing what you already have and maybe taking some money out to go into a passive investment. And then there's also this assumption. There's also this assumption idea of I'm going to buy something that's maybe at $83 a door as opposed to everything else in my area that's $113. And I think that you're going to see a lot more opportunities over the next 12 months where people got in and said, I have to buy 1,000 units by Tuesday. And they got in at a time when we were right at the top. We were going down, so they overpaid for it to get in. And then we got hit with COVID. We've got evictions, we've got bad debt, we've got unemployment, and they can't hold on. So maybe an assumption is a great alternative for you to get in. Know your market. Going to properties that have a high military concentration is going to stop your, not stop, but it's going to limit your ability to get this great type of lending. So know what kind of people are in the properties, what kind of people are being drawn to this area and would be living in your assets. Understand what your investors want. What is the cash on cash expectations of your investors? And from an investor standpoint, what are you going to be returning to me? Ask these questions. A lot is going to be changing over the next 6 to 9 months or 12 months. Are there any questions that I can answer? I think I've covered a whole bunch of stuff, and I'm happy to have you ask the questions. Remember, I'm here to help you. I'm here to answer questions. I'm here to say, how can I help you? How can we take this transaction, and not go away when you have more education. We and my team are here to take down and help you take down transactions.
Great presentation, Julie. It was very informative.